Alibaba is down 6% year to date. It is down 70% or so from its all-time high of $320 per share. Now, guys, I own Alibaba. So first off, that does not mean go out and buy Alibaba. I'm a guy on YouTube. Now, I want you to listen and understand my process. And if it speaks to you, follow. Get on board, but never ever buy anything because anybody in this world, even Warren Buffett, has it. Buy it because you understand it and you believe in it. So in this video, we're going to go over Alibaba high-level metrics. We're going to go over some analyst estimates. We're going to go over some news and some bull and bear cases from our community right here. We go to them to say, give us your bull and bear cases about Alibaba. We're going to finish out the video with our 8 pillars. And then the question everybody's wondering is, what's the price to pay for Alibaba? And we're going to use our stock analyzer tool to find that out. So in this video, we're going to have things for beginners all the way to more advanced investors and everywhere in between. All I ask, pay attention to the entire video, because as the video goes on, the information gets better and better and comes together nicely. So if you get confused because you're new, don't worry. I was confused, and everything that's worth it is hard to start before it becomes easy. So let's go check out Alibaba right now. Alibaba is a $223 billion market cap business. That means if you wanted to buy every single share outstanding, it would cost you $223 billion. Now, its enterprise value is $235 billion. That difference is essentially their net debt. Taking all the cash, paying off the debt, etc. You get to buy the entire company with no debt and no cash for $235 billion. Now, that's a low number because their free cash from last year was about $29 billion. That's a huge, huge free cash flow number. So I love their balance sheet for that reason. It's hard for companies with low debt to go under, just like it is for you as an individual. The less debt you have, the less likely you are to declare bankruptcy, right? In fact, you have to have debt to declare bankruptcy. No different for companies. All right, look at this. All-time low, $58, not all-time low, 52-week low back in October, $58 per share from an all-time high, not even 2 years before, of $319. Oh, how the mighty have fallen. So what's caused the fall? Well, the news. All these stories about China and ADR, the funny part is the story existed when it was 320. But when the stock starts to fall, people start to pay attention to news. News follows the stock price, not the other way around. News will follow the stock price. If a stock price is going up, the news will say, look how great the company is. If the stock is falling, news will say, look how terrible the company is. Look at Meta. Meta was at $88 a share in November of last year, and they said Mark Zuckerberg was an idiot. Now it's back up to $300. Mark Zuckerberg is a genius. Really? In 8 months, 9 months, he went from idiot to genius? Give me a break. All right. Current PE is 19.3. 5-year PE is 14.8. Profit margin last year is down a little bit, 9.4 from 15.8, and a pretty decent gross margin of 37%. This gross margin is the amount that they make on every additional sale. So if they bring in $100 of extra revenue, about $37 of it goes to the bottom line to pay taxes and give profit. So not bad, pretty high number, considering Amazon is low double digits. Even stabilized is probably 20 to 25 or 30%. Walmart is mid 20s. So a lot of potential there for the company. All right, let's go check out the 8 pillars on Alibaba. Now guys, remember, if you're part of our community, you can customize your pillars up to 12 different pillars and it'll just pop up right above here. But there's 2 X's here. Net income is down and ROIC is low. Everything else is a check mark. But I want to show you something. By the way, look how low this 5-year PE is, 11.8. So guys, what I was talking about earlier on the debt, this 1.8 number for the 5-year free cash flow to debt ratio, that means if they repeated their last 5 years of free cash flow, it would take them 1.8 years to pay off all their long-term liabilities. That's incredible. Cash flow growth, net income is down, but revenue growth is up. I love the fact their cash flow is up $8.5 billion. I don't care about net income. It's probably some sort of financial. The thing you have to understand is net income has all these accounting rules, everything rules, GAAP, how they report it. Cash flow is much harder to manipulate that number, a lot less modifications to it. So I really like this. This makes me happy. Just like the price of free cash flow over the last 5 years being 11.8 versus the PE of 14.8. So guys, this company's in China. China has the fastest growing middle class in the world. The average person in China makes $12,000 a year. That's the per capita income in China. In the US, it's like $75,000 or $80,000 a year. They have so much more room for growth. They have 5 times more people and they have one-sixth the income. Imagine that growth potential, and Alibaba will be there to take care of them. That's part of my bull case on Alibaba. Let's go check out the other bull case on Alibaba from people in our community. So let me go pull up Alibaba. Ooh, a lot of comments. Love it. Oh, Taylor Nowacki said, bear case, Munger sold it. He didn't sell all of it. He sold half his shares. He did say it was a tax loss harvest, which means he took the write-off to write off his other gains. But he did say it was his biggest investment mistake because he thought it was more tech than it actually is. So let's go see what Sakati says. Regulatory scrutiny. Alibaba has been under increased regulatory security from Chinese government in recent years. That is correct. Delisting risk. Big risk that everybody's been worried about. They could get delisted from the US. I called Merrill Lynch, my brokers, and said, guys, I own Alibaba stock. What happens if they get delisted? They told me, Paul, your shares will get converted to Hong Kong shares, and if you ever want to sell it, it might just take a little bit of time to come back to the US. I said, but I won't lose my money? Nope, they told me I'm not going to lose my money. But please verify with your own company. Again, don't just take my word for it because I'm on the internet talking. All right, economic slowdown. The Chinese economy is slowing down. It's slowing down, but it's still, their idea of recession is 4% growth, not 8% growth. Their recessions aren't like our recessions. Competition, okay, increased competition from other tech giants, maybe so. Foreign investment restrictions, but they've done a great job. Chinese government does not allow foreigners to, that's why they have ADRs. Their shares can't be owned. You don't buy a piece of the company when you buy an ADR here in the US. Okay, bull case. Large and growing market. China is the world's largest e-commerce market, correct. Diversified business model. They have 6 different divisions. They're splitting those up into 6 to unleash some value. Strong financial performance, consistently been profitable, and strong free cash flow. Yep. Regulatory tailwinds. The Chinese government has been easing some of its restrictions lately on Alibaba. Great. Strong management. Sure. Attractive valuation. Thank you very much for mentioning that. Let's see what other people say. Bull case. Any possible risk, even WW3, World War III, is more than priced in at these prices if you believe Americans will always be allowed to own Hong Kong shares in case of delisting. Okay, fair enough. Dan H., pre-plague, ROC of 20% with steady net profit around 35%, low debt. So I think their ROIC has dropped a lot, but I think it's because of some of the financials and how it's calculated. Chinese buying back shares. So they are buying back shares. They announced a buyback program, which is big numbers for Dan. And Dan shared his stock analyzer tool, which I won't show here. Alibaba is starting their own AI app, competing with Meta. Okay. They're getting sued by JD. Okay. Not estimated yet on the damages. Bull case, not paying a dividend because they're trying to expand the business. Good call. But they are buying back shares, though, Alexander. Okay. Wicked Willie, Dalton, our in-house analyst. Alibaba could spout cloud unit spinoff alone is worth 41 to 60. By Cloud Intelligence Group. Let's see. It's estimated by 2030, Chinese middle class will grow by 45% from 2022 levels. Awesome. 2 bear cases. A recent report has shown Chinese consumer spending is weak. Yeah, but that's temporary. That's not going to be permanent. According to research by Shopify, the consumers 18 to 34 have become a dominant e-commerce spending, while Chinese youth unemployment surged to 21%. Okay. There's some engagement in here between everybody. Guys, a lot of great commentary here. All right, so Sakati, I'm going to give you, for the most information you gave, great. I'm going to give you either a t-shirt or we can give you a discount of the software. So either one, reach out to help at everythingmoney and let them know that you mentioned this in the Alibaba video and they'll help you out. So thanks very much. And thanks to everybody in our community who engaged here. The engagement has increased and it's been awesome. So keep going with it. Let's go back to Alibaba. Let's go see what the analyst estimates are in Alibaba. Expected to make $13 a share in 2028 versus the $7.50 they were estimated to make in the year ending March of this year. Some decent growth there. Not a ton, but decent growth. Revenue, high single-digit growth. Not as much as I would have thought, but 122 billion in revenue all the way to 193 in 2028. So some good growth with a good gross margin will really add to the bottom line. They'll be able to buy back shares. All right, so we looked at the 8 pillars. We did all this. The final question is stock analyzer. What is the price to pay for the company? Now, guys, before I get into it, I just want to take a quick second of your time. So if you're the type of person who's watched our video, which you are now, or watched other of our videos, it shows to me that you take investing in finance very seriously. This is exactly why we built the community up here as well as the software behind it. This is the stuff I use every single day for my investment research and analysis. So just a few weeks ago, one of our most active members, who was actually a newer member, reached out to me and he said to me point blank, Paul, I think you're missing out on a lot of great people like me. And he was pretty cocky about that, but I liked it. He said, I didn't sign up for your software until I got 7 days for $7. He's like, I didn't really want to spend 30 or 40 bucks plus my time trying to test it out. But once you gave me the $7 for 7 days and I tested it out, he said, and I quote, I realized I couldn't live without it. So he went a step further. He said, instead of charging $7, why don't you just give it away for free? Let people test it out. They will get hooked. It'll be awesome. So that's what we're doing, guys. No credit card needed to sign up. All you need is an email. I can't even take your credit card info. I can't even take your money. That's how confident I am you're going to love the software. 7 full days for free, full community, and all of these tools available for you. No restrictions, nothing. Sign up at everythingmoney.com, the link below, everythingmoney.com/sign up. Go try it out. It's 7 days for free, fully. You cannot be charged money to sign up. So go do it now. I guarantee, just like this user, it'll change the way in which you look at money and investing. So please do it. You're not going to want to miss out on this. Thanks very much. Let's go back to Alibaba. Now let's go look at my history on Stock Analyzer tool. I did an analysis in Alibaba on August 14th. So I'm going to pull it up just to see what assumptions I made and see if I still agree with them. All right. So we did a 10-year analysis. And for my revenue growth numbers, low, middle, and high, I did 5, 8, 11%. All right, seems reasonable. I thought to myself, okay, 5's low, but I don't mind being conservative. And 11% is higher than analysts are expecting, but it is in China. I actually thought to myself, I'm actually going to make the highest one. I'm going to change it to 12%. Not much of a difference, but I feel comfortable with that. Now for profit margin, here's something I want to show you guys that I like. Profit margin versus free cash flow margin. Over long periods of time, they should be equal. But look how much higher free cash flow is than its corresponding profit margin. That I love. Most value investors won't even look at a company if the profit margin is higher than the free cash flow. This is exactly the opposite. This shows that they're showing more free cash flow than profit. And most people look at this number here. They don't look at free cash flow. So this is going to be some untapped sources. Eventually, they're going to even out somehow, okay? So I put 17, 22, and 27. Now for PE, we put the PE currently 19 and 7.6 in the price of free cash flow, 7.7, but it's not about where it is today. Where do you think it's going to be in 10 years? What would you put the company's PE and price of free cash flow? What I like to do is I like to start at 15. That's the market average, 15 or 16. I go up for returns on invested capital, moat, and growth rate. And I look at China saying, this is going to be the world's largest economy soon. I literally want to make sure that the largest company there that could have the biggest benefit of a growing middle class gets a premium for that. So I put 16, 18, and 20 for both of these. In the final row, desired annual return. If you can get 9 or 10% from investing in a long-term ETF, you should probably get a premium for investing in an individual company, depending on the company. Now, obviously, this is a Chinese company. There are a lot of geopolitical risks, et cetera. So the more risks there are and the higher assumptions you make, you need to have a higher desired return. That's your margin of safety. The more return, the less price you pay. That's your margin of safety. So I put 12, 14, and 16. Now, again, all of these numbers here, guys, are what I put in. You could have very different numbers. We saw that Dan in our community had different numbers. So whatever your numbers are, if you don't like my numbers, if you do like my numbers, come in the chat, tag me. I'm at Uncle Paul. Tag me and tell me what you would do for Alibaba with the assumptions here. All right. Now, I'm gonna hit the analyze button. I just need you guys to stay with me 1 minute longer because I want to explain the numbers. It's really important that I don't just give you fish. I want to teach you how to fish. I want to explain these numbers so you can understand what they mean in respect to this current stock price. Low price of 107 to 120, high price of 240 to 280, middle price of 160 to 180. All green. Doesn't mean go out and buy. It means go do research. But that means at the current price of 87, if you bought it right now and the low assumptions occur, you'd make about 17% return. The high assumptions occur, you'd make 36%, and if the middle assumptions occur, 26%. Again, this does not mean go out and buy it. It means go make sure you're not missing something. So in our community, let me know what I'm missing, because I do own Alibaba and I plan on keeping it for a long time until something tells me otherwise. Thank you very much for your time. Go sign up for 7 days for free at everythingmoney.com/signup.